How's that? Any better? All right. Okay. Good morning, team. Something as went a little bit of a little astray this morning. It looked like it was coming through, but it wasn't. But there we go. Hopefully you guys can hear me now. Sign language day. The only sign language I know is thumbs up. All right. Hey, morning team, morning crew. Good to see all of you guys. The old little technical glitches. But anyway, thanks for being patient. Good to see all of you guys on this morning. Another Wealth Coffee chat on this terrific Tuesday. Thankful Thursday. Terrific Tuesday. Thankful Thursday. But anyway, good to see you guys here. Thanks for coming along. Aaron, Alison, Melinda, Luke, Andrew, Bryce, Marcus, Kelly, Brendan. Good to see all of you guys this morning. Thanks for joining us. Fantastic to have you along. Anyone who's new, if you're new, say hello in the chat. Love to know where you're coming in from. Let us all know. Thanks for popping along and hanging out with us. As it said there a minute ago, Jason Witten's my name. Been doing these little get-togethers each morning on a Facebook Live or a YouTube Live with some cool, crazy crew, maybe just like you, mad property investors, keen on dialing some of the finer things down when it comes to our property investing. Been property investing over 20 years myself, coaching property investors across Australia and New Zealand. It's coming up. It's coming up, folks, to our 20th year. Coming up to our 20th year. There you go. So interesting things we've seen along the way. Done a few deals, and each morning share a little bit of the experiences and understanding that we've learnt along the way. I was doing some research the other day on our clients' portfolios, and collectively, and we've got a little bit more data to get in, and we haven't included New Zealand yet, so it'll be interesting when we do it. At the moment, we're at 7,661 properties. 7,661 properties our mentoring and mentoring and coaching clients own. That's pretty cool, right? Along the way, when you help people buy 7,661 properties over a 20-year period across 2 countries and 5 states and 2 territories in Australia, you learn a few things, and that's what these mornings are all about, folks. Just helping you guys and ourselves make a little bit of sense of what's going on, short term, medium term, long term, and see if we can go the distance in this thing that we're doing, which is called property investing. So, thanks for hanging out, thanks for joining, thanks for being here, etc., etc. Hey, this morning I thought we might talk about something, what I call the danger zone. The danger zone, and it's the danger zone is mostly, folks, when there's stress and pressure as a property investor, and we end up having some second thoughts about investing. So I wanted to sort of go through that with everyone today, because let me do a little drawing to sort of put in perspective. Along the way, we all know that it's going to be a 15 to 20 year process of putting our portfolio together. All right, putting our portfolio together. And in the early days, you guys have seen this, hopefully heaps of times, plenty of times, the acquisition. This is where we're acquiring our properties. We're increasing our properties, which is great. But what else increases in the early days? Tell me in the chat, what else increases pretty significantly in the early days, in that sort of first, 7 to 10 years? What is often within that first 7 to 10 years that at maximum for us as investors, and it's probably the first time we've ever had this much stuff. Yeah, debt. Right. Yeah. So, debt can be scary, right? It can be scary if we don't understand it, if it freaks us out a bit. And we need to know the difference between good debt and bad debt, right? The good debt and bad debt. You know, good debt. Good debt. What's good debt? You can chuck it in the chat. I'll sort of write it down anyway. What is good debt? Well, good debt, you know, creates income, consistent income. So you buy something that creates a consistent income for yourself. At some point in the future, you get some growth out of that debt, like the debt owns an asset and it grows. You might get some tax deductions from it. And also, debt allows you to have leverage, loan-to-value ratios against your property, okay, which is awesome. Okay, so you could put down 10 or 20% and you could buy you know, if you had 100 grand, you could buy a $600,000 property. That is pretty good. Yep. Tax deductible debt. Exactly, Luke. Exactly. That's technically good debt. Bad debt. Bad debt is things like it has no income. So it's got no income. Okay. Or if you buy a property that costs you an absolute arm and a leg to own, that you've got to pour money into, you know, $10,000, $15,000, $20,000 a year, depending on what you're trying to do, depending on your position. Some people do that because they want a holiday house and they put money in. It devalues. There's no tax deductions, and you get no leverage. Okay, and things like this are cars and, you know, credit cards and all this consumer stuff, right, folks? So debt. Bad debt, good debt, okay? So just going to get rid of those for the moment because I want to talk about, you know, today what I call like the danger zone of owning real estate. And it's certainly attached to or associated with debt and a level of debt. So let's look at this. Let's have a bit of a conversation. At some point, let's say this is the value of your real estate. At some point, you want the value of your real estate to go up, right? That's awesome. That's fantastic. What does happen from a cash flow point of view, and let's just talk about that, is these lines, this one here. So, you know, capital value and rental income. Now, they're not necessarily completely tracking like this, folks. Like, that doesn't work exactly like this, but it's easier for me to draw it a bit like that today. But let's have a look at the cost of our debt. The cost of our debt often is like this, and what we're looking to achieve is over here. This is where the money's at, folks. This is where the money's at. Okay. That's where the money's at. That's where it's all the fun is. Okay, over there, when your debt is low and your cash flow, your rents are high. Okay. Oh, what's going on there? Oh, here we go. I'm writing outside of the outside of it, and the rents are high. So, I'll do that. So I hope that's making sense, right? So you know, what is the danger zone here? Where is the hard part with this team? Where's the tough piece? The tough piece is here. The tough piece is here, where there is a negative gap, sometimes in the form of equity. The equity gets squished. Sometimes in the form of cash flow. Sometimes in the form of something. Okay, so this negative gap in this acquisition phase usually takes between 3 and 7 years on average, depending on how quick you're sort of going. You know, and over here, you guys know this. You know, this is the consolidation stage. We call this the manage, maintain, and maximize stage. And over here is, you know, lifestyle and legacy, right? Lifestyle, legacy. Okay. How are you going to pay it forward? How are you going to add value to the world, you know, or have fun, or whatever it is for you? You know, it's your rules. You do what you're going to do. Okay, so in this spot right here, we're talking, this is our challenge that we have to navigate through, right? What I call the danger zone. Danger zone. And it's danger mostly because sometimes we're committed to, attached to, the property can't stand on its own 2 feet just yet without your, guidance, right? So let's have a look at what that means. I've got something I've prepared a little bit earlier, and let's have a quick look at, how it might look from a cash flow and dollars and cents point of view. So let's go in and have a look at a property here. Now, let me go back for a second. The point is, team, how do we get more comfortable when we do, when we own a property? All right, we'll do that in a second. I'm going to do that right now. Where am I? Share screen. All right, so let's just have a look at a property, where did my little mousey go? All right. My mouse has gone onto my iPad. My mouse went onto my iPad and I couldn't get it back on the screen. Anyway, technical glitches, folks. So, here, let's have a look at your property. And we're going to buy a property today. I'm going to put that at 0. I'm going to make an equity deposit of an equity deposit. We're going to use equity. There's some basic numbers in here, folks. Interest only. That's at the moment you can get 4%, but it'll probably go up a little bit. 600 a week. Really low growth. I always put in 4% there, but you're going to achieve way more than 4%. CPI over the long term, 3%. At the moment, it's a bit higher, but don't get carried away. It's not going to be here forever. What does our property look like? Where's the gap? Where's the challenge? Where's the issue? All right, so let's have a look at this, team. Up the top, here's the danger zone. So if you have a look at available equity at 90%, okay? So when we're talking about lending, and this is a little bit technical, so stick with me this morning, stick with me. A little bit technical, but it's important to understand. When we're talking about lending, you might have something that's worth, 500K. You might have something that is worth 500K, but you can only, get access to 90% of it, or 90%'s a bit more difficult, but what's a really easy loan to value ratio, the LVR against a property, folks? Put that one in the chat for me. What's a no-brainer? Okay? 90%, no-brainer at 80%, okay? So when we're first starting out, what happens for all of us, and it's just part of the process unless you've got a lot of cash, a lot of savings, a lot of equity somewhere, 80%, Luke, that's it. We often use 90%, so that's fine. No stress, no issues, okay? And sometimes we use equity from our existing real estate. So let's go back to our property here. So if you look at the top, team, technically that property by itself takes quite a while, depending on the growth and if you're doing debt reduction. Getting access to any equity in that property, would take anywhere, depending if you get some growth or not, anywhere to 5 to 6 years if it's going to have some growth. And this is on an interest-only loan. So, you're not paying much off. And in the first 10 years, P&I loans don't pay themselves off very well anyway. So, this is where some stress comes. All right, I'm all in on this property. There's no equity available on that property. And this property here, it's in a sort of a growth location, but it has a negative pre-tax cash flow, right? So after-tax cash flow is positive, is perfectly fine. And you guys know about the difference between pre-tax cash flow and positive after-tax cash flow. So this is where a bit of stress comes from. This is the danger zone. So if you look out here, if you can see on the screen, you know, depending on the rent growth on this property, you know, it might take, you know, 5 to 6 to 7 years for it to become pre-tax positive cash flow, before tax positive cash flow, and, you know, give you access on a 90% loan to value ratio of $121,000 to purchase another property. Okay? Everyone sort of following along? Hopefully it's making sense. So it's usually around this 6 to... Oh, it's not going to do that, is it? Okay. It's usually around year 6, 7, and 8. If you do no debt reduction or anything like that, that your property becomes kind of like, hey, it's fine, I can take care of myself. Everyone following along? Tell me if it's making sense in the chat right now. Because before then, ladies and gents, you have to have your tax refund chipping back in to make the property positive cash flow. Everyone, so... And there's nothing wrong with that. That is a very normal process of buying good quality real estate in great locations, and the cash flow is neutral to positive after tax. Okay, so this is a challenge for us from a investing point of view to keep our psychology high when it comes to investing, team. So it's that usually. Let me go back to that. It's usually this section here that gives us the stress and pressure. How can we fix that? What can we do? There's a few things. Obviously, what's one way to feel a bit more comfortable, team, when you own a bit of real estate? Chuck that in the chat for me. We always talk about it. It starts with a B and a B-U-F. And it's not Buffy the Vampire Slayer, but it sounds like put that yeah, Brendan, you know, it takes its time to find its groove. What can we do? Excuse me, get the frog in the throat. What can we do to speed it up, team? Well, you could, if you had cash, some people have got cash to invest, you could have cash in that property. Buffer equals security. You're dead right, Stephen. You know, for me, for you, I would be saying tax variation. Boom, Luke, for sure. So buffers, doing your PAYG tax variation. And if you do have some cash in a deal, can you see, team, can you see this here? When you have a look at the loan to value ratio, and up the top, just check this out, right? It's not magic. It doesn't take Einstein to work it out. When you have a loan to value ratio of around 80%, so 20% of it is owned, is debt free, and 80% has some debt on it, check out what happens, right? Check out, isn't this kind of like, oh, that's interesting. You know, when you get to about an 80% LVR, so the value goes up, you might reduce some debt, and the rents track with it, team. The rents track with it. That's when the property becomes self-sufficient. So, a few ways you can get it to being more self-sufficient quicker really is the conversation for today, really is this idea. Oh, not there. Where am I meant to be going? There. Number one, you can put cash as a deposit. Okay, so if you have spare cash, then as a deposit or in offset accounts, etc. Number two, you can certainly, which is easy and instant and fast, your tax variations. Number three, the sooner the rents go up, the better off you're going to be. And that's why, when we talk about real estate and the area that you buy the real estate in, can those properties rents go up, over the next 5 to 7 years? That's really important for that property to be then standalone and self-sufficient. Okay, so there's a bit more technical this morning. Dived into a few little maybe detailed things, but hopefully that made sense, team. Yeah, Melinda, interest only at the moment. We're seeing sort of high 3s, early 4s for interest only. But check out, it's interesting right now. It's a bit of a weird time with your interest rates. And just like the thing, it's important to understand that whatever you get sorted now for your interest rate, unless you're trying to fix your interest rate, which I don't suggest you do unless you really have a high reason to just know exactly what it's going to cost you for a fixed period of time. You can always change your loans, Melinda. So if you lock in at something now, or you get something now and it's 4.4%, maybe later on you can change it to, interest only or principal interest. It's some of the principal and interest loans are a bit lower, and the net dollars and cents is a bit cheaper as well. So it's not an easy one to talk about unless you know exactly what your situation is and what you're trying to get, Melinda. But good question. The answer is yes, you can get them in the 4s, still fine. But you have to be a good borrower. You're not getting it at 90%. You're not getting it if you're kind of if you're self-employed and those sorts of things, Melinda. So it all depends. But there you go. Good question. All right, team. That's it. Wealth Coffee Chat done and dusted. You guys be good, be awesome, be well. Join me tomorrow for another one. Fabulous Friday. We'll hang out and do the do. And I'll see if I can get my audio working here properly next time. All right. See you guys. Bye-bye. Have a good one.